with a safe deal. Which point we couldn't really refuse. So we just kind of ran with it and decided to raise with that same term from other investors. So we had to take a lot of calls because from a lot of VC's perspective, our term was like ludicrous. But it ended up working out pretty well. Oh yeah, no board seat. Board seat was like almost like a deal breaker for us. Um, Observer, no observer, just cash for safe. Um, so that's actually why we needed to talk to like maybe like 180 or 90 investors, take a ton of calls, and then kind of dragged it as well. It ran for a long time. So it kind of really depends on like what your appetite for fundraising is. Like if you're fine with giving up more and like not spending too much time on it, that's your style as well. If you prioritize something else, we prioritized ownership above anything, so we just kind of did it for a long time. That was kind of our style. It was uncapped. Yes. Yeah, so that's why it took a while, and it was pretty yeah.
So we went through Y Combinator. So we had the initial investment of 500K. And then, can you guys hear me? Okay. Okay, cool. And then after we did YC, we did demo day. And at that point, after demo day, we actually closed on demo day, but the entire fundraising round to raise that initial round was about 2 weeks. So we ended up raising total around 3.3 mil, and that's carried us to almost 3 years later now. So it's been a great amount of money for us. I think the process for fundraising, especially at this early stage, it's all actually kind of a mental game in terms of creating that sense of FOMO in the investors and really keeping the momentum going in your conversations and making sure you're really tight on following up, really tight on your pitching, really tight on your slide deck, and making sure you're really tight on the bullet points that you want those investors to remember about you. So at this early stage, they only care about 3 things: team, traction, and market. Depending on how early you are, you're probably not going to have traction. You're going to be probably pre-product, pre-revenue, pre-customers. So really lean in on like the traction, the team, and then the market. So if it's a really big market, really hype that up. But I think your team cannot be understated, like who you are, who your founder is, like whoever the team members you have are. You need to sell like the crap out of your background, why you're uniquely positioned for this, why you are the best person to build this and no one else can replicate this. Especially if you don't have product. And I think in this age of AI, like there's not really a technical moat you can necessarily build at these early stages sometimes. So just leaning again on your unique experience and what you really bring to the table is going to go a long way there too. And then, like I said, with the whole process too, like there's so many things you can do, like in terms of scheduling, like just do investor calls back to back to back. Put the ones that you want to get practice on first, and then just like keep drilling them. We had a ton of no's too. Like we talked to probably like 150 investors too in the span of a couple of weeks, and got a ton of no's. So it's a mental game. It's kind of like you got to slog through it, but I think there's definitely some things you can do to kind of make it a little bit easier.
Yeah, so one thing that SoftBank's Son-san, Masayoshi Son, mentions that, well, if you aren't really getting the interest, tell a bigger story. But the other piece there is like sometimes in terms of like the pedigree of your team on the professional side of education, maybe you feel like you need to round it out. Just invite a handful of folks to be your advisors to really round out what that initial team can look like.
I think I want to emphasize what Jocelyn said about like really milking your like past career. Like I feel like if you studied something in college that's like tangentially related to what you do, or you had like worked on something in your previous workplace, like really like I don't know, don't lie or anything, but like I did statistics in college, and I don't really care for it, but like I was like, oh, I'm an AI genius because I know the AI is a statistical model, blah blah blah, like whatever. And like I did marketing at McKinsey, but I was like, oh, at McKinsey I did these projects and I didn't have like super niche insight into this industry, blah blah blah. It's like you're just selling yourself. You're kind of the product early in the phase, so it's super cringy, but like you have to be able to be like, I'm a genius, I'm super cool. So yeah. Thank you. I appreciate that.
As an investor, if you don't sell yourself, then the investor's thinking, how are you going to sell yourself to customers? How are you going to sell yourself to teammates? So you better be your best advocate. I want to hit on a couple points they said because I think it's really important, is that you need a large top of funnel. Someone said they met with 150 investors. Someone said they met with 100 investors. You need a massive top of funnel, whether that's investors or customers. Another thing people said was relationships, whether it's schools you went to or a company or your ethnic background or your military veteran status. You need to find the investors who will understand you the best. And then once you talk to those investors, the questions they're going to ask you are, how long is this funding going to last you? What are you going to do with the capital? Meaning, what experiments are you going to run? And what does success look like? Are you going to go raise another round? And how much and when? The last thing I'll say before I pose a question to my esteemed panelists is cold email works. And I heavily believe in cold email. I believe in cold email for customers, for investors, for teammates. And so my question to you all is, how much cold email did you all do? How much was it pre-existing relationships? And any interesting or cringy fundraising moments?
Mark Cuban was a cold email. Yeah, I think his email is still like mark@markcuban.com, something like that. I don't know if cringy, but the most memorable for me is we had our Series A lead down to the wire, before penalty kicks in at midnight. They pulled out. So we had like about a month of cash left at that point, and we basically have to have the talk with the team. It's like, hey, we're going to try hard, but we're going to extend the runway a little bit if folks can be paid a little bit less on that side. Yeah, I'll say that the first company, that initial pre-seed seed, yeah, maybe a third is like a cold email. But I would say that seed A onwards, not too many cold email. Those mostly just like investors introducing us to folks they know at that point. Yeah.
I think we ended up taking like 180 or 90 calls, and then maybe like we knew like 5 of those people starting out. We met them through like events. We met them through intros. We met them through the first person that ended up signing the check. We were like, hey, do you have friends who also might like us? That tends to work a lot because that investor has now stake in your company, and they also want other people to support that person. So that was it. I don't know, cringy moment. I think I was always super shy about kind of sharing my background. Like I did statistics at Harvard and then I went to McKinsey right after, but I never really wanted to talk about it because it's like, oh, you went to Harvard or whatever. And my co-founder, he did his undergrad at MIT and he also never really wanted to share it. So it was always kind of like oh, you guys like went to great schools. Why don't you say that in the first email? Because we never did. But like towards the end, our emails were looking like, I'm like a super genius who did statistics at Harvard, and I was like a top consultant at McKinsey. My co-founder's like, honors student at MIT or whatever. Like it's super cringy, but you just you got to do that to stand out. So that's kind of what we did.
For us, I think maybe like 10, we did like 10% cold emails. We were, when you go through the YC demo day, they have the investors watching and they'll reach out to you. But I would say if this counts as a cold email, something we did do is, look at our friends, like our network, and like other fellow like co-founders. And if we saw that they were, funded by a VC that we thought had a particular interest or potentially could be a good fit, we would type up like word for word an exact email for them to send and then give them that email and be like, hey, all you need to do is just send this to them. And so it made it really, really easy for them to like forward our information along. So like pre-write out all your cold emails, like lean on your network and just have them send it. And then, that was typically like a good way to get some people interested. And also never share your deck. Don't share your deck in a cold email. Like you put your blurb, put all your attractive statistics in that blurb, make it like 5 sentences max because investors do not read emails, long emails. I feel like Tim, you can tell me if that's true or not. So make it as like short, snappy, and like punchy as possible. And then when they get on the call, do the deck, and then you can send the deck after you follow up. But don't show your hands, too early in the game. Cringy. I mean, there's like a lot of cringy ones. I feel like, you're on a call and you're talking to a VC and they clearly like do not care about what you're talking about, but you have to power through the slide deck anyway. That's pretty cringy. There was a company that I worked at before I started this company, and I was actually really good terms, like really good relationship with that VC that funded that company. And so when I built my company, I reached out to them and I was like, hey, like let's chat. And I did all the conversations with them. I think I went through like 5 rounds of talks with them. It was like great. They were seemed super bought in. Did that last call, and then they sent an email like 24 hours later that was like, thank you for your time, and we're gonna pass. So sometimes it's a little bit of a, again, like I said, a mental game. Like investors will say a lot of things when you're talking to them, and sometimes there'll be a lot of interest, but it's never a closed deal until they actually say it is too. So again, going back to the mental thing, it's a little bit of like a mental game, and you have to just be like realistic and make sure that you follow up and make sure people actually commit when they will.
And just one last point, right? I mean, obviously it's extremely elitist. The folks here, right? It's like Stanford, Harvard, Stanford, right? It's not representative of like the typical venture journey, but it is a numbers game in the sense that it's cold email, right? It's like, don't be afraid if folks say no or don't reply. They don't actually give a shit about you, so don't take it personally, because all you really need is that you get one, right? You get that 50K, you get 100K, then get 2, you get 3, and that's how you build from there, right? So don't be deterred.
One mistake that I made, though, that I don't want anybody else to make is like when you talk to one VC and they say no, you kind of check that VC off of your list. But what you should be doing is checking that person off of your list and not the firm. And if another person from that VC is there at an event, like go talk to them and be like, hey, Daniel from your VC said no, but are you interested? Because that's how investment works. It's not the firm that invests, well, it technically is, but it's the person. And if he or she is interested, like they will do the investment. So make sure you like think of it in like individual namespaces. Yeah. Well, I guess it's kind of different. I guess the junior people are the ones that tend to like want to push you because they're also building it and it's also their career, like who they can invest in. So having those juniors on your side is kind of also key. I think a lot of like cool startups tend to be like, oh, juniors, we don't want to talk to you. Like, take me to your IC or partner or whatever. I don't necessarily agree with that. I think junior or associates are the ones that will vouch for you and send you to their partners with like good points about you. So I think, cherish every people you meet, I guess, is kind of my take.
Yeah, it kind of works when there's pattern matching. It's like you're another thing comparable to that, and they can make the case why you're different. If you're doing something that's very unique or very greenfield, just go straight to the top. The other thing is like if you did talk to one of the GPs and on the IC, and they say no, but someone else says yes, that like it, please let them know that you talked to the other guy already, because most of these ICs, they need at least 2 of the partners to sign off. You don't want it to be like, I fucking love this thing, and then it's like, no, I hated it. You don't want people to be blindsided like that.
A few things that they said that I think are really important to double click on. The first is Jocelyn mentioned the importance of team, traction, market. What we really care about is all those, but more importantly, what you do. And so it's the speed. How fast do you ship product? How fast do you go to market? How fast do you talk to customers? How much feedback do you get? How responsive are you to investors? The second point is the first check is the hardest at the pre-seed stage. And that's not the friends and family, because that should be the easiest for you to raise. And don't get me wrong, Not all of us come from a place where friends and family can invest. But for institutional VCs, whether it's a 150K check or 250K check or 500K check, that first check is by far the hardest because investors are generally not completely lemmings or FOMO-ish, but like we like to see some validation beyond just customers, and that means other investors. And then know the investors. I think Tom mentioned this. Make sure you know, do they invest in your stage? What check size do they generally write? Do they lead or not? And then if you have a good meeting with them, ask them about their process. Is this going to be a 30-day process? Is this going to be, I need to talk to multiple people on your team? And then now back to the speakers. How much of what you pitched is what you're doing now? That's part one. Because I think a lot of founders sometimes will pitch a story and they're just like, I just want to pitch a way that will get funding. And then the second question is, how can people in the audience help you? So who are your customers and how can they be helpful to you?
So we more or less stayed pretty close to what we initially raised for. When we applied to YC, we were focused on conversational AI, but it was actually in the HR space. So then we pivoted to healthcare in YC. But it was funny. I was looking back at our pitch deck actually for pre-seed, and I was like, oh wow, like a lot of this is actually tracking like 3 years later. So that was kind of cool to see. I think especially as this, the AI landscape has changed, we've probably made a bigger focus now on like, R&D and less so necessarily on like the technical mode, but more so about like our product experience. Like how are we giving the customers that we have the best user experience possible? Like I think it's really easy to deploy AI apps now, but it's harder to deploy an AI app or a solution that is like, a white glove experience for that customer. It has that stickiness, it has that retention, and that kind of long-term like scalability and usability. So like, at NoTex, we're really building a platform that will automate all administrative tasks for doctors so that they can just focus on patient care. So from day one, we weren't just focused on like one aspect, but we thought kind of holistically about the whole system. So we do, like for example, like automated note taking, but we also do automated coding and medical billing for insurance. And we also do like patient-facing summaries and like order placements for the doctors for like prescriptions and medication. So we're building a suite of tools, and that's always been kind of our day one goal, and to really disrupt healthcare, because healthcare is like this just crazy legacy, inefficient industry that I think if you can just take a little bit of that inefficiency and automate it, then the returns on that are huge. So we are actively hiring. So if you guys are a software engineer, backend AI specific, interested in healthcare, voice AI, NLP, anything like that, really would love to chat and just get a sense of your interest in the space. And yeah, I mean, really happy to talk afterwards, but that's kind of me.
And if you know of any doctors.
Oh yeah, doctors, yeah. Introductions, we have an app you can just download and get started with right away on the store. Yeah, if you have any friends, physicians, anything like that, I'd love to talk.
We are extremely different from what we pitched to our like first investors. We pitched like a marketing tool, and the whole pitch was that I was a marketing consultant at McKinsey, and I was gonna automate a lot of the things I did, which the investors liked. Now we're doing like an AI interviewer, right? It's super different, and that's okay, honestly. Things happen. You notice different things. Market's not the way you thought it was gonna be. It's just the way it is. I had a Zoom call with investors, and I was like, it's different now, and they were like, okay, whatever, I guess. So it just happens. So it's okay. And how you can help me is, shameless plug, but we're building, we're an AI interviewer company that's actually focused on software engineers. So we specialize in our AI-driven recruiting of software engineers. We do everything from sourcing and screening. So it's like by far the cheapest and the easiest way to hire software engineers is our service. So thank you.
The top line did not change for the company. So my background is on the ML side of things. So I would say that in the research community, we're pretty aware, even by like 2015, 2016 or so, that 99% of public data that these systems train on is how white and East Asian males buy stuff and watch stuff. It is not representative, of society at large. So the top line of looking at how high quality alternative data can help to enable these systems to be more precise, does not change. But how we got about doing that changed a lot. I think we pivoted like 3 times along the way. Very greenfield again. It's not something for the faint of heart. Yeah, I think the plug for me is like, we know how to make money with AI. We have a lot of money. I know how to get the best talents on the AI side. But what I'm looking for is really like strong folks with an operations background from like lived experiences that can be more, not relatable, but empathetic, the plight of the average family, being on $400 of emergency savings, Jim the cashier, that type. People with experiences, having lived in that community, I'm actively trying to break out, from this elite, highly elite bubble that I'm in, because like what we do, if we're successful in New York and California, it doesn't mean anything for the rest of the country, right? So how do we actually do something that can be good for everyone?
Cool. So I am going to ask one more question and then open up to folks. So start thinking about what your questions are. How prepared are you for your next raise? And will you do a next raise? So there were some founders who raised some funding. I mean, this is rare, but like a MailChimp or Atlassian, where they just like are so successful that they can just grow without venture capital. Zapier is another one. Those are very few and far between. But when I mean how prepared, psychologically and numbers-wise in terms of the company. And this might not apply to everyone.
Yeah, we are definitely interested in raising another round. I think that is very much the goal for this year. We have been scaling and growing pretty quickly, and we just want to keep continuing that momentum. So I think like if you can raise for growth. Like if your graph, for growth looks like a hockey stick, just like keep riding that. I think psychologically, honestly, I'm really proud of the team that we've built, like the team of the engineers and our kind of our core, like we're still in a sub 10 team. And I think every single person on that is like a 10Xer. So for us, like I love this team that we built because I feel very supported. At least like it's not just like co-founder and I, building in my little apartment. So having that strong like team support and that kind of the buy-in and just knowing that everybody is going to, I think, commit fully to getting us to that next round helps a lot, just psychologically with that. But yeah, I know it's a slog. I mean, the next round, like for a Series A, is very different than a pre-seed or seed. The metrics, the traction that they're looking for, I think this market is different. And yeah, so I'm excited about it, definitely. But I think it's going to take a lot of like preparation for that this year.
I'm not excited about it at all. But I think the thing is with Series A, things are a lot more robotic and systemic than seed, where things tend to be more of like story oriented and more human centric, where okay, like you have an experience in this, so you're gonna go to this market and do this and this and that and become a unicorn or whatever. Whereas Series A, you have some level of numbers to base things off of. So is it on track? Is it not on track? Things become a mathematical equation rather than a storytelling. But there's going to be, well, I don't know, I wouldn't know, but I think you guys would know better. But there's going to be a lot more numbers-oriented equations. So I had to be more logically prepared for those questions. But yeah, that's kind of my mental preparation, I guess.
We're profitable, so that's awesome. But it also means that we're not as aggressive, I would say, in terms of our growth that we can be. I think there are a few windows that we're looking at where if this is true, we're going to race, that kind of thing. And that for me is like, if, for example, this year we have 2 giant enterprise integrations that we need to do at once, yeah, I need to be way more inefficient with capital deployment to get up and running. But fundamentally, have the right playbook, to do so. But a number I'm thinking about just in terms of the total raise, right, is like Plaid raise about what, $600-700 million, for open banking, if possible. And then on the other end, have like Stripe as an infrastructure, and that's like a couple $1 billion, to do that. I think for us, at the end of it, I'll probably need to invest about $1.5 billion to $2 billion to do what we do. But whether that's from revenue, from dilutive capital, from R&D grant and all that, I think can be creative. But I think if you have something that can be profitable, and I think that's the most important thing, whether the investors have convictions that the more of what you do is the unit cost of that going to go down or go up, and how high is that ceiling in terms of where that can be. Because I think, unless you're like the General Catalyst or Andreessen, many of the funds are still struggling to close their post-COVID fund. And if they're still investing out of that last one, I'm telling you, like they have that one or two checks, $50, $100, for that pre-IPO thing, just so that, that fund is less ugly on their, cap table. But just keep that in mind.
A few points. First is the graduation rates get much, much harder, especially Series A. If you can raise a Series A these days, like the path to IPO is much, much clearer, but raising the Series A is so painfully difficult. We see that with the companies we're in. The next is what was Series A few years ago is now a seed round, and what was a seed round a few years ago is now pre-seed. And then the joke these days, I'm sure you all have heard, is that in a few years it's going to be pre-seed. And then the next is it's easiest to raise when you don't need to raise. Obviously, if you're cash flow positive, if you're incredible growth rates, investors will be coming to you rather than you having to go fundraise. Any questions from the audience? Sir. So the question for the audience was, when you went to go do your pre-seed, did you have a minimum viable product, and how large was the team?
We had a clickable wireframe. We had clickable wireframe, so it was like on Adobe, and then we had a couple of screens, and if you point at it, it just takes you to another screen, that kind of thing. Team, just the core, me and my co-founder, yeah.
I think we did have an MVP, and we also had like an enterprise company as like a design partner. So that also added, some level of insurance to that project, and it was like 5 of us, so me and my co-founder and 3 or 4 engineers that built it.
Adding to that, right, it depends on the product, right? Like for me, a enterprise sale is minimum $5 million, right? If it's a 50K thing, then you can like whip an MVP, but I can't whip out MVP.
Yeah, they were all full time.
Yeah, we had an MVP. It was we had a product that was being used by doctors at that time, so it was like not great, but it was usable. And we actually had like investors bring their doctor friends on to like use it during it, so it did get stress tested quite a bit. And then it was just my co-founder and I, so we didn't hire our founding engineer until after we closed the round.
So the question is, he was surprised that cold email works, and he said, what type of cold inbound has worked best for us? So I'll use 2 data points. Our last 4 deals that we've done in the last 6 months, 2 of them were cold inbound. So this is scary because now maybe I'm going to get a lot of cold LinkedIn inbound, but both of them were LinkedIn. However, both of them were also military veterans. So they knew that like that was like our core focus. And they were also working on things that were completely, how should I say, non-sexy right now. One's embedded payments for law firms, and then one is around surveillance and just geospatial dual use stuff. So yeah, but LinkedIn, at least that was for me. Any other questions? Please raise your hand. Sir. So the second question was around valuation. Can you talk about kind of the valuation in general? And we'll ask folks about, at a high level, what was the math behind the valuation? Check. But what was the first question? Got it. Got it. Okay. So I agree. If I'm a founder, I would not send a deck until I'm at the meeting. Don't get me wrong. I'm always, whenever I get a cold email, cold message, I'm always like, send me a deck or a business plan. I'm weird in the sense of I actually like business plans more than decks because I just think I actually like to read stuff rather than a 14-page slides with just numbers up and to the right constantly. The valuation aspect, I asked them to take a first stab before I chat about it.
Again, this is not representative, I think, of general landscape, but for us, like, based off of the idea, we were able to raise like at 10 plus, safe. We prefer pre-money, just because we just kind of kept it open-ended, and safe was a pretty flexible vehicle, you know, for us. Again, that's not the norm.
They just kind of gave it to us. It's not really up for your negotiation. Like, you can't really give yourself a valuation. But when we still haven't gotten any sort of valuation or cap to our safe, and another investor asked us, "What's your valuation?" I may or may not have said something along the lines of, "Oh, they're thinking about giving us this much valuation," or something like that. You know, you're obviously not lying, but it's kind of like you're testing out the waters of like how far you can go without seeming like an idiot and getting kicked out of the room. So it's kind of a balance game there for sure.
Yeah, I think valuations they can be crazy, and like they're all kind of just based on vibes sometimes. And like if you're an AI company, your valuation could be just insane pre-revenue, pre-product. So I'd say like if you're just doing the math as a founder, like have a couple of plans. Like you know, YC says do a cockroach plan, do kind of your optimal plan, and then do a growth plan. So your cockroach plan is like you're not getting it, you're getting very little money. So you know, how much do you need to raise to have that plan, and then kind of what's the valuation based off of that? How much will that dilute you? You know, your optimal plan is obviously the exact amount that you want to raise, and then the over dilution plan would be like, okay, like we're taking more capital, we have a lot of interest, you know, but at this valuation, like how much am I willing to kind of dilute myself to get more of that capital? So I would say go into it with a plan, go into it with like plan A, B, and C. You know, kind of keep your valuation, you know, stable throughout those plans, but be ready to kind of negotiate and be flexible a little bit in your approach because you just don't know what's going to happen when you go out there.
Yeah, just some proxy. I think a lot of seed I see is like around like maybe 8 to 20, and then A I see between 50 to 80, so maybe like 90, not like raising 10 on 100, that kind of thing. But that's more on the edge case. Unless you're pretty confident that what you do now can carry you, you know, to that next round. Sometimes you may get that one term sheet that's like very, very attractive, high valuation that you put on there. But if you take that and you can't really deliver, it may be really hard, you know, for it to, you know, get to the next, you know, raise. So just finding that balance. And of course, like, I think folks that have done investing here in the last 20 years and have made some money, you know, they're all about giving back. They're okay with, you know, higher valuations and all that. The moment you go outside of the Bay Area, across like Austin and even New York, right? It's folks are different in terms of the way they're thinking about these things.
I have a few thoughts on that, and then we have time for maybe one or two questions. So the first is on valuation terms. So much of that information is now public. It is shocking compared to 5 years ago how much you can find. What is a typical valuation at pre-seed, seed, Series A? Carta has that. PitchBook has that. AngelList has that, so on and so forth. Second is at the pre-seed stage, we've invested in companies. This is going to, I think, surprise some people at 2.5 million post money to up to 40 million post money. And so that's a giant spread. The 40 million post money were folks who had sold a company before and are spinning out of a large company and have Sam Altman, other people as investors, building AI. And then the one that was smaller is first-time founders, military veterans that don't have much startup experience. The next is on the type of how you should raise it, whether it's a safe convertible note or price round. In my opinion, at the pre-seed stage, if you're dealing with thoughtful institutional investors, it should be on a post-money safe. To try to do anything else is just probably unnecessary. I have some thoughts around board and board observer, but that's probably for another day. Any questions from anyone else before we wrap this up? Sir.
Yeah. Yeah. So I think, if that's okay, right, is like find the most famous person in Arizona State, be their best friend, and have that person refer you to comparable folks that they have as on boards or whatnot. And using that as a starting thread is like, well, if this kid can get to me through that guy, that kid may know other people like that as well. And I would say that, sometimes you don't need to say everything. Is that, yeah, we are in conversations with other comparable folks.
Yeah, that we are in conversation with that VC. I mean, you are technically in conversation if you had one interview or one chat. So we just talk to every VCs out there, and the next meeting we just pick out like the most prominent VC, and we just be like, yeah, we're talking to them right now. I mean, that's obviously not lying. So yeah, that's kind of what you have to do.
Yeah, I mean, a lot of our connections were made from like the email of an email of an email of an email of an email. So it's like, talk to your, really lean on your network. Like, if you know someone that knows this person, ask them to make connection. Then like a lot of our connections, like a lot of our first customers and like investors came from like just like multiple networks and different chains. So yeah, just like look at your Rolodex. Don't be afraid to just reach out to people. Like, people are really kind. Like, if you make your email like personal and like you're genuine about what you're asking for and you just want a shot and like an intro, most of the time they're probably sending it along. And so long as you put some effort into what you're actually asking them, like don't just send like a general email to like 50 people. Like, just actually like personalize what you're trying to get out of them, and I think that really helps with response rate.
Like, people want to help, and the more effective you can be at articulating that deep conviction in what you do, that this is you going all in, you make it easy for people to help you. Like Roy Bahat, at Bloomberg Beta, he has a good template in terms of like how to make it easy, to get like an email intro and stuff like that. But again, right, don't lie to yourself. If that's what you want to do, right, you really have, double down on that. And people can feel it. And I would say that, the VCs, they know the game. But the thing is, like, if you don't play the game, then they think you're an outsider. Right? So whether you agree with it or not is be at peace that this is the game.
A few notes to close us out. One is Context Ventures, we're pre-seed investors. We like to do fast no's. So if you're like, wow, like we just met and this is a no, don't take it to heart. I promise you, I think if you asked them, they would have said fast no's are better than like where they string you along. The second is we love doing events. Tom likes to do events at Qlay. There's an event actually here tomorrow that's that we're also doing. That's AI and marketing. We've also got an event later this year. That's a creator career conference that's here. We're doing an early stage startup conference here. And we're also incubating a company called Startup Intros that we hope will connect founders to investors. I know there's a lot of companies in that space, but we think we have a unique advantage there. And if you want to work on a company with us here, come talk to us, come talk to me, because we're constantly trying to start new things. Stick around. We've got probably another like 30 minutes of networking. The last request I have is I'm going to take a selfie with the folks on stage with you all in the background, and then we'll call it wraps. Thank you all.